You've probably heard of high yield savings accounts that are offering 3.5%, 4% rates. Yes, 4% is supposed to be a high yield. The national average for savings accounts is 0.37, and considering inflation is 7, 8, 9, and money's being manipulated, you're still losing 4 or 5% easily on your money. But it wasn't always like that. On your screens right now is a historical average CD rate from 1984 to the present. Yes, back in 1984, the 6-month CD interest rate was over 9%. The 5-year CD was almost at 2%. So they can't give us higher interest rates? The thing is, they don't have to. There's no regulation requiring them to offer higher interest rates to their depositors. More importantly, they know that people have no choice but to put their money in the bank. Well, they have choices. Our financial system is designed to discourage physical cash transactions. However, banks argue that it's a matter of investment maturity. As you know, banks don't keep your cash in a safe when you deposit it. They invest it in different assets. A huge chunk of their money is in treasuries, long-term treasuries. Of course, banks need to get a yield on their assets that is greater than the cost of the deposits, including the overhead, administering the program, employing people, etc. They can't just sell the investments they bought last year. They need for it to wait for it to mature if they want to maximize the yield. In turn, they calculate the interest they provide in accordance with the money coming in, and as any good businessman will do, they need to be conservative in their estimates. The path to maturity is not a paved road. When economic disasters happen like the one we're having right now, investment banks could fail. When periods of high inflation hit the country, the value of the dollar goes down. That means their yield isn't as valuable as it was when they bought the treasuries. The question is, how conservative do they really have to go? It's hard to determine exactly because regulations don't really require them to disclose that information. Banks don't suffer any consequences if they cheat their depositors. They also know that we don't really have a choice. We need banks currently. We're designed to lend money to banks. Yes, when you deposit your money to a bank, you're effectively lending them money. We at Noble Gold Investments would never advocate against any asset, including cash. So we certainly don't undermine the importance of banks. All we want is to remind you that you cannot put all your eggs in one basket, and you certainly put all your money into cash. Diversify, diversify, diversify. And when you diversify, make sure you have assets that go up against traditional assets like cash in the market. Gold typically has an inverse relation with the market and cash. Historically, if it goes up when cash and the market are down and stable the rest of the time. Of course, you need to talk to a financial advisor, but if you're looking to get gold, real gold, physical gold, Noble Gold Investments can help. Call us and talk to a live person here in the U.S. on the other line to talk about your options or any questions you may have. This is a no-pressure conversation. 877-646-5347, or you can open an account and start protecting your wealth today by going to noblegoldinvestments.com.